Welcome back to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and that is...
Bono.
Not true. That is Brian Leverage, and today we have a fascinating topic. Well, it's fascinating to me at least. We're going to talk about one of our investments, one that we raised capital for, and how we're making investment decisions in a changing market environment. And we're going to do that right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
All right, so I hope you enjoyed that. Bono over here is going to tell us what property we're talking about. So what property are we talking about?
This is a 20-unit apartment building we bought in the submarket of Red Bank, submarket of Chattanooga, Tennessee, where we film these shows. And we purchased it in just over 2 years ago at this point. I want to say it was February or March of 2021. It was all 2-bedroom, 1-bath units, needed extensive renovations due to a lot of deferred maintenance at the time we acquired it. Our plan was to remodel units organically, which we did over time. And we hit a few snags along the way.
Yeah, I mean... Well, let's be honest. We created a budget for what we thought it would cost to remodel. Then COVID caused everything to be much more expensive than we thought. So we didn't have enough money to do all the work that we needed to do. Now, the good part is we did have a pretty healthy operating reserve. So we were able to, we were able to do a lot of the expensive big ticket stuff early on. And so we got that stuff out of the way. But on the turns... the cost per unit went up significantly.
Well, that, and also we had some expanded scopes of work that weren't included in the initial budget that we felt were sort of critical to do. Case in point, like redoing staircases, sandblasting those down to the original steel finish, repriming, and then repainting everything. That's just one example. But what I will note is, when we underwrote this property, we underwrote, and this is where being conservative helps, right? Is we thought market rents $775 plus another $50 a month water and sewer bill back. Right now, today, we are renting those same renovated units out for $950 to $999 plus a $65 a month water and sewer bill back. So we have outkicked our coverage on underwriting, which is great. That kind of makes up for...
Yeah, so this is the double-edged sort of inflation, right? One side, it's really beneficial to us because rents have gone up faster than we would have expected. And because we underwrote them conservatively, there was already margin there. Like we thought, well, we'll probably do this, but we might do that. And it turned out we did an even higher number.
We had a subject to appraisal at the time we bought it of $1.9 million based on those numbers. By my math right now, the building's probably worth about $2.5 with
right.
where we're at.
Yeah, and so, I mean, from a pure purchase perspective...
And we paid $1.1.
Right, buying it for $1.1, maybe spending $500,000 in renovation at this point.
Yeah.
But at the most, right? Mm-hmm. So maybe we have 1.5, 1.6 in it, and it's worth 2.5. I mean, so that's a pretty nice uptick in equity.
Right. And that's sort of the caveat is... We're in this position where we have really good debt in place on it. We have a loan that doesn't mature for another just under 3 years at this point, 20-year amortization at 3.5%. So right now, our debt service is roughly $6,000 a month, I want to say, and we're probably amortizing close to $3,000 a month in principal.
Right, which... And just to take people back, so this is a property that we raised money for through a syndication. If you don't know what syndications are, we have that episode there about syndications. But basically, we pooled investor money together, and our plan was, at about now, around 2 years, we were going to refinance and pull out capital, pay the investors back, and then continue to own it. And now, because of interest rates having gone up so much, that's a less good option.
Yeah, so as we sit today, we've renovated 13 of the 20 units, right? And that's in addition to renovating the entire exterior of the building, putting on new roofs, windows, siding, gutters, the whole whole ball of
And the
wax.
staircases,
Staircases, yeah.
and resolving a water intrusion issue, and
Yeah.
all sorts of things were done.
And the challenge right now is that, it's a balancing act. Sometimes, we get into these things, of course, we can't control what happens in the greater economy. We always do try to buffer what we felt was even a conservative budget at that time, but of course, we didn't anticipate supply chain issues related to COVID and other inflationary
Material costs
pressures.
going up by double in some
lumber
cases.
shortages, et cetera.
Yeah.
So, so that's been obviously a learning experience for us in that regard. But we had several options. One option would be to go back to the investment group, maybe do a capital call for $100,000, which would
To finish the last
finish out
7
the remaining
units.
units, right? But that's not ideal because when we put these things together, people invest in you based on their trust in you, in the project too, but really they're placing their capital and their faith in you as an operator. So it's important to keep your word in these situations, right? Because that's what they're going off of in the first place. Now again, like we mentioned, you can't control all these things that may happen, and sometimes a capital call may be necessary. In this particular instance, though, we have a couple other options that are probably more ideal.
Right. So one additional option would be like a line of credit or something on the equity that's in the property, and we have looked at that option. But another one, and I think what we've kind of settled on is because rents have come in so much higher, we're actually renovating it out of cash flow. So every month or so, we're getting enough extra cash flow.
2 months is 2 months of cash flow pays for one unit,
Right,
at
so-
a pretty high end.
Yeah, and then each additional time it accelerates that, right? So if you renovate one and you move the rent from 500 to 1,000-ish, right?
And that's a great point you just touched on. We still have the remaining 7 units that we have not touched are legacy residents who are paying between at least when we bought it, $400 and $500 a month in rent. We've increased those some. In fact, we've got one that's going to be moving out here next month, I believe, because of that. And we will, renovate that one, rent it out higher. We're even going to spend maybe a little bit extra putting in laundry to see if that will juice our rent. And then if so, we'll go ahead and do that on the remaining ones, which will really expedite things as well.
Yeah, and I'll make sure to put in the show notes too, by the way, some links to the property, because we're going to have some listings and stuff like that.
And the reason we're wanting to do all this in the first place is it's a well-located property, right? It's if you're looking at a map of Chattanooga, it's about 5 minutes from downtown, give or take, right across the river. It's got great freeway access, etc., proximity to downtown. There's also a lot of development that's going in the adjacent area, just down the corner.
Brand new property
Townhomes.
directly in front of us. The townhomes being developed right on Dayton Boulevard there. So yeah, we love the area long term and believe the rents will continue to go up. This is a property that we've always intended to hold for an indefinite period, and we continue to believe that that's the right move. Now, on the flip side, it has been a bit dicey, right? Because now we have 2 years in this particular case with our investors' money out there where we haven't been in a position to make any distributions because all of the cash flow has been going back into renovating. And so one of the things that's really important in a situation like this is to balance the interest, long-term interest versus the short-term interest, and make sure you're communicating effectively. And that's one of the reasons why I wanted to make this particular episode, so we could share this with you if you are investors out there in this particular property and let you know what's going on. Mm-hmm. So you still feel good about the property?
I do. I think really our original plan of rehabbing it and refinancing it, essentially BRRRR, right, is still in place. It's just with a bit of a pause in terms of the amount of time that it's taken. We'll still do the same thing, and I think, frankly, with inflation doing what it's doing, we're seeing now price per door on C and B class apartments in the $100,000 range, and that's plus capital expenses to rehab those units on top of that. So the fact that we've got essentially a turnkey product puts us at a competitive advantage to most of those properties, in my opinion.
Yeah, and I mean, if we were going to sell, we could almost certainly get a reasonable price, and everyone would do really well. But ideally, interest rates will dip back down a little bit. We don't know if that'll happen or not, but if it does, at that point, we would probably want to reach out and quickly grab a lower rate and
kind of arbitrage the timing.
Yeah, pull some of the money back out, pay the investors back their initial capital, and then at that point we would be in a really good position to start distributions. Of course, flip side of that, if interest rates continue to remain high, we may choose not to refinance in the near future, and we might decide that we get to the point where we have enough renovated units, or really, say 6 to 8 months from now, when all of them are done just out of cash flows, where we can just start distributing a much higher cash flow amount because of our relatively low interest in payment now.
Yeah.
So anyway, I think that about wraps up the information that we have about that. Now, if you have any questions about this or any show that we do, you feel free to reach out to us. And in the meantime, we hope that you're having an amazing week.